Now let's look at this question. This is based on CA business level past paper questions. Let's go through the questions and we'll see the solution. Use the following information to answer question 1, 2, 3, 4, and 5. Sam company is planning to invest in a project that has an initial investment of 780,000. So 780,000 is required, is the investment. Annual forecasted cash inflows for 5 years are as follows. And also you are given the cash flows for the 5 years. The company uses 12% as the cost of capital. The investment contains machinery that has an annual depreciation of 20% on straight line basis. So now you are given the cost of capital and also you are given the depreciation. Okay. And what is the payback period of the project? How do you calculate the payback period? Now, what is a payback period? The payback period refers to the amount of time it takes to recover the cost of an investment. In other words, we can say the payback period is the length of time that an investment reaches a break even point. Okay, so if the break even point is shorter, so it will be an attractive investment. Shorter the payback, it's very attractive. So how do you calculate the payback period? So to calculate payback period, we need to identify the cumulative cash flows. So when you calculate the cumulative cash flows, then the year in which the cash flow becomes positive, that will be considered as the payback period. Okay, so to calculate, now let's take the cash flows here. Now first of all we'll take year 0, year 1, year 2, year 3, year 4, and year 5. We'll take year 5. Now we know the cash flows. Year 1, we have to pay 780,000 cash outflow. Year 1, how much is the cash inflow? 150,000. So year 1 cash flow is 150,000. Year 2 cash flow is 220,000. Year 3 cash flow is 340,000. Year 4 cash flow is 400,000. Year 5 cash flow is 300,000. Now we'll take another column for the cumulative cash flow. So when you take the total, so this is the 780,000. So now 780 plus 150. So that will be how much? 630,000. Then 630 plus 220,000. So how much that will be? 410,000. Then 410,000 plus 340. So that will be still, it will be a negative balance. So 11 minus 4 is 7. 11 minus 4 is 7. 3 minus 3 is 0. So still it's 70,000. So 70,000 plus 40,000. So there it becomes positive. The cash flow become positive here. in year 4. Okay, so part of the 70,000 is recovered during the fourth year. So therefore, the payback period should be 3 years plus some months from year 4. Okay, so year 4, we need to identify how many months. So this 70,000 will be recovered from 400,000. So therefore, what you can do is 70,000 divided by 400,000 times 12. So that will give you the number of months. So let's calculate that. This 70,000 divided by 400,000 is equal to 0.175 times 12 months. We need in months. So that will give you 2. Okay, 2.1. So we'll roughly will take 2 months. So that will be 3 years and 2 months. Okay, so this is the answer. So therefore the correct answer, you are given four answers, of which you need to select the correct answer. So according to this calculation, it will be 3 years and 2 months. So this is the correct answer. Now let's move on to the second part. Second part, what is the discounted payback period? Okay. Now in the previous question we discussed about the payback period without discounting. Now here we need to calculate the payback period which is which should be discounted. So discounted payback period. Okay. So to calculate discounted payback period, what we need to do is we need to identify the present value of the cash flows. To calculate the discounted payback period, we need to identify the present value of the cash flows. To calculate the present value, we need to discount the cash flows by using the discounting factor of 12%. So our discount factor is 12%. So we need to convert the cash flows into present value cash flow. Then calculate the payback period. So that will be the discounted payback period. Okay. Now let's take the year-wise cash flow. Let's quickly will take. We have year 3, year 4, and year 5. So cash flows will be 780,000. Then we have year 1, 150,000. Year 2, 220,000. Year 3, 340,000. Year 4, 400,000. Year 5, 300,000. So let's take the discounting factor at the rate of 12%. So this discounting factor rate will be given, the factors will be given in your exam. So let's take the discounting factor rates. The 12% discount factor rate will be up to 5 years, So this is the rate we need to take. Point discounting factor table. So year 0 will be 1, and year 1 will be 0.893, then 0.797. Year 2 will be 0.797, 0.712, 0.636, 0.567. So these are the discounting factors. Okay. So now we will calculate the present value. Okay. So present value will be the cash flow times the discounting factor will be the present value. So let's calculate. So the present value of year 0 will be 780,000. There is no difference. Then the year 1 will be 150,000 times 0.893. So that will be 133,950. Then year 2 will be 220,000 times 0.797. So that will be 175,340. Then 340,000 times 0.712, that will be 242,080. Then 400,000 times 0.636, 254, 400. And year 5 will be 300,000 times 0.567. So that will be 170,000, 170,100. Now, after calculating the present value, you need to you need to take the cumulative present value cash flow. So that will be 780,000 outflow, then 780 plus the year 1 cash flow. So which will be 780 minus 133,950, the difference. So it will be 646,050 negative. Then again this minus 175,340. So that will be 470,710, still negative. And this plus this cash flow will be 242,080. Okay, so still negative 280, sorry, 228, 630 negative. Then minus 254, 400. So it becomes positive 25,770. This become positive in year 4. So therefore, our payback period should be 3 years plus, it should be 3 years plus certain months from year 4. How do you calculate that? Okay, so the negative balance at the end of year 3 is 228,000. So this has to be recovered from this cash flow. So therefore, we'll take the ratio 228, 630 should be recovered from 254, 400. Then times 12 months. So that will give you the payback period. So 228, 630 divided by 254, 400, that will be 0.898 times 12. So that will be 10.78 months. So we will roughly take 3 years plus 11 months. So this is the payback period. So what is the answer? You are given four answers. What is the discounted payback period? So that will be 3 years and 11 months. So answer will be B. So this is the correct answer.